In this video, we're going to be performing a deep dive on Lowe's dividend safety. To begin, let's talk about Lowe's business model. Lowe's Companies is the second largest home improvement retailer in the US after Home Depot. The company, which has a current market capitalization of $71 billion, was founded in 1946 and is headquartered in Mooresville, North Carolina. Lowe's serves more than 18 million customers per week in the United States, Canada, and Mexico, and generates sales of more than $70 billion last year through more than 2,200 home improvement and hardware stores. Lowe's is a well-known dividend stock because of its compelling track record of dividend growth. With 56 years of consecutive dividend increases, Lowe's is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. In fact, Lowe's dividend history satisfies the requirement to be a dividend aristocrat more than twice over. With more than 5 decades of dividend increases, Lowe's is not just a dividend aristocrat but also a dividend king, an even more exclusive group of stocks with more than 50 years of consecutive dividend increases. Looking ahead, investors cannot rely on Lowe's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Lowe's dividend safety in the context of the company's current earnings. When Lowe's reported fourth quarter financial results on February 27th, the company announced that it generated adjusted earnings per share of 80 cents in the 3-month reporting period. For context, Lowe's currently pays a quarterly dividend of 48 cents per share, which implies a payout ratio of 60% in the most recent quarter. Looking out over a longer time horizon, the company's dividend coverage is even better. Lowe's generated adjusted earnings per share of $5.10 and distributed $1.85 of common share dividends during fiscal 2018 for a dividend payout ratio of 36%. The company's full-year dividend coverage looks so much better because the winter months are typically weaker for Lowe's. Using earnings, Lowe's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's current dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Lowe's dividend payments to its free cash flow. In fiscal 2018, Lowe's generated $6.2 billion of cash flow from operating activities and spent $1.2 billion on capital expenditures for free cash flow of $5 billion. The company distributed $1.5 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 30%. Using free cash flow, our conclusion is the same as when we use earnings to measure Lowe's dividend safety. The company's dividend appears safe for the foreseeable future, and we note that its dividend coverage using free cash flow is actually better than the earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Lowe's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Lowe's performance during this time period is shown here. Lowe's earnings per share declined by 39% peak to trough during the 2007 to 2009 financial crisis. With that said, the company's earnings continued to cover its dividend payment, and Lowe's continued its multi-decade streak of dividend increases. With that in mind, we don't have any concerns about the company's ability to continue paying rising dividends during future economic downturns. The last angle that we will use to assess Lowe's current dividend safety is by looking at the company's debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. At the end of fiscal 2018, Lowe's had $15.5 billion of total debt outstanding. The company generated $624 million of interest expense through the first 9 months of the fiscal year for a weighted average interest rate of 5.3%. The following image shows how changes to Lowe's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, Lowe's weighted average interest rate would need to rise to well above the 20% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Lowe's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.